Commissioner for the Tennessee Department of Economic and Community Development right here in Nashville, Tennessee. I also have the privilege of introducing a good friend of mine today. That would be Dr. Bill Fox. And Bill, who I've known for many, many years, currently serves as the director for the Boyd Center for Business and Economic Research at the University of Tennessee. Go Vols. He is also the former chairman of the economics department at the University of Tennessee. And Bill really has so many awards, we just don't have enough time to share those with the audience, Bill. But let's just suffice it to say, he has been a person, an economist that many of us in the state of Tennessee have relied on throughout the years for all things economics-wise, including forecasting, including putting together strategic plans for the future. And so it gives me a great honor to introduce my good friend, Dr. Bill Fox.
Alan, thank you very much. It's certainly my privilege to be with you today. Thank you all in the audience, wherever you are, for joining us today. And I look forward to talking to you about an economy that, you know, Alan, it's just such an unusual time to talk about. And so I'll tell you what I'm going to do. I'm going to talk through some of what's happening nationally in the near term. You know, the real challenge right now is I'm used to saying, okay, what's going to go on this rest of this year? And I'll look back 6 months ago to give you some data or tell you what happened in 2019. And now I feel compelled to talk about what happened last week or what's happening next week. Things are changing so fast. It's a unique period in which to try to measure economic activity for sure. And so it's a tough time for any of us doing this kind of look at the economy. But with that in mind, what I'd like to do is, again, talk about the national economy. I'll show some slides about what's happening across our region. And then if there's time at the end, I'll talk about some long-term trends because, well, I think the key thing from an economics perspective in the long term to take away from coronavirus is a bunch of trends that were already happening have been accelerated. But there also are some trends that are just going on, like demographics and the aging of the population and the really low birth rates that are going on. And maybe the birth rates have been lowered a little bit by the pandemic, but it's continuing this pattern of what was already underway. So I'll look for those long-term trends if we have a chance at the very end. Well, so this first slide I brought up for you is just to show you the most recent data on GDP. And I mean, anybody looks at that chart and say, did I just slip at the end and my pen kept drawing or something that it wasn't supposed to? You can see how dramatically the economy fell in the second quarter. A couple of thoughts about that. First of all, when economists present this kind of data, they annualize it. So we're sitting here looking at what happened in the second quarter if that rate of decline continued for 4 quarters. It will not. The recession started in February. It probably ended in April. So it was both the steepest and fastest recession any of us have ever seen. And so a really difficult time in terms of trying to understand what is going on here. We actually had 5% decline in the economy in the first quarter, 32% in the second. And I think we're going to see pretty sharp growth here as we look at what happens in the third quarter. We'll know that in about 2 months. Now, this chart is intended to put this recession in the perspective of what's happening over time. And so I've listed, those are just a bunch of different recessions. And the line gets back to zero. That's how many years did it take for the economy to return to the same employment it had at the peak of the previous economic expansion. And so notice, I mean, over to the far left, you have to look hard to realize it's there, is this recession. You can see how much faster the economy dropped, with 14% drop in employment in a month. You can see we've actually come back pretty far, but even with all the return, we something like 18 million jobs lost in the beginning of the recession, and we've added back 8 million or so of them. Still a lot of unemployed people in the economy. You can see the Great Recession, the '07 recession, took a long time to get back to the previous employment levels. But one of the things I see as I look at this chart, and if I went back further all the way to World War II and I have a similar chart that shows that, you'll see that historically we returned to our previous levels of employment in 2 years. Here, we have not done that in recent ones. And one of the things I'm going to ask you here, we'll do a poll in a few minutes, but I'm going to ask you when we get around to that poll to think, well, when are we going to return and recover from this particular recession? And it's a tough issue for all of us, for sure, to understand that. Here is unemployment rate. I'm sorry. I'm trying to get this technology to do just what I want. There we go. Here's unemployment rates. You know, the U.S. rate went up to almost 15%. Incredibly high on any kind of historical standards. Again, it's dropped back a bunch, but it remains very, very high on historical standards in the U.S. for sure. Now, one of the reasons why we've come back as quickly as we did so far, and I want to emphasize that so far, it has been federal stimulus. Let's put this in perspective. There was 3 times more stimulus already in this recession and rebound than we had in the Great Recession. We're talking about something like $2.5 trillion to households to help them keep their balance sheets in good order. Business is getting something like $1 trillion. State and local governments getting something like $800 billion. Now, you know, state and local governments, at least that I interact with, are saying the real challenge is they don't have much flexibility on spending it, but a lot of money has gone out there, and it has helped stimulate the economy, help keep us from having things deteriorate much more than they otherwise would have. But to put this in perspective, this is what happened. This is the deficits for the U.S. Now, you know, we'd have different views if everybody could be asked here about the tax cut that was passed in 2017. And regardless of how you think about it, it wasn't financed by cutting spending. And so we already knew that there were going to be rising deficits as a result of those tax cuts. Now what's happened, and the reason, by the way, if you look at that blue line that's going up, that's what would have happened without the pandemic. And you see the deficits were going up anyway. And the reason for that is actually pretty simple. Demographics. As the population ages, what we spend on Social Security and Medicare was rising rapidly. And so we were already expecting deficits to rise. Now look at the impacts of the pandemic. The red line showing what's already enacted. The gold line showing what happens if we get additional stimulus. And of course, it depends on the degree of it. We've all heard the politics of this. Should we continue to extend the enhanced unemployment insurance benefit? Should we give more money to state and local government? Should we give more money to business? Should we just send money out to people? All this getting talked about. We'll watch the politics of this in coming days and weeks and months. But no matter what we see is a massive increase in federal deficits. And the outcome is, as a share of the economy, U.S. debt will be 100% of GDP by the time we get through the pandemic. And okay, so that's incredibly high in U.S. historical standards. It's nowhere near where Japan is. It's nowhere near where Greece is. And so, is this a problem? Well, it depends where you're coming from. It's high compared with many countries, but we can think of plenty that are at least as high as the U.S. Well, let's look at how this has played out for your state. And I apologize, person I asked to draw this was careful to always put orange. Alan, notice that orange around the Tennessee Vols here. He was careful to put a little orange on Tennessee, and it this is just the set of all the states and what's happened. Now, keep in mind, this is not the employment loss that initially took place. This is after the rebound that took place. So we have big losses in March and April, and then beginning to rebound in May and June. We'll get, by the way, on Thursday afternoon this week, unemployment rates and employment situation for your state, so you can see what do things look like at that point. But notice it's a pretty different situation. Depends a lot on your economic structure. As you know, this recession and impacts of COVID-19 have not been evenly felt across the economy. The services sector, and I'll show you a chart in a moment that shows how much services have been hit. The services sector has been hit much, much worse than the goods sector. And so if you're in a state where goods production is coming back, you're in a lot better shape than a state that might be depending really heavily on services. I think of states like Florida, for example, and a lot of tourism and how that's slow in coming back. I think of cities like Nashville, where that remains a very big concern. So we're just in a moment going to have a poll, so if they could get the poll ready to send it out. And the question I'm going to pose to you is, how long does it take for us to recover in terms of employment and output from this particular recession? So look at that. Here's unemployment rates. Again, they differ really radically by state. Now, if there's somebody from Kentucky on here, you should have noticed that Kentucky had the biggest loss in employment, or right at the biggest, and it has the lowest unemployment rate. Now, something seems a little amiss about this if you think about how the data fit together. And so what's happened in the data for Kentucky is a very big reduction in the labor force. Seems to me there's likely something that's amiss about the way the data are going, and so you want to take a look at that and see what's happening in Kentucky as we get this week's data finally released. So you should have had a chance to get out and see what the poll says and how long it will take. I'm trying to look at this myself and see how quickly it's come back. Sorry. Oh, here it is. So I see that many of you are expecting it to be the middle of 2022, and I think that's a pretty good assessment of what's going on. I applaud you and laud you for having a pretty good perspective on how long it's likely to take for us to recover from this particular economic environment. And so we'll see how it plays out. Some of you are a little bit more optimistic and thinking by the end of next year, numbers still coming in as I look at them here and evening up a little bit with as it continues to come in, people getting more and more optimistic. I hope you're right. I hope you're right. It takes a long time. And this is the discussion we've been hearing people talk about. Is this a V-shaped recovery? Is this a U-shaped recovery? Is it the square root? And, we're going out to all the mathematical symbols now to say how long. Here's some reasons why I think it'll be a little bit slow. The first one is that Congress has just thrown money in. The president has thrown money at this, and mostly I think a good idea. I'm not going to support every single thing done, but putting all that money out there, putting out so quickly, really helped minimize the effect of what otherwise could have been a devastating time. And so great news there. But the stimulus, most of that money's already out. And unless we get a really big increase in stimulus over, let's say, the next year, then something like the beginning of 2021, we're going to see that stimulus coming back out of the economy, and that will tend to slow things down. A second thing, and I'm going to show you more about this as we go along, I think there's going to be a lot of people who aren't going to have jobs. People have been laid off, think they're going back. They're not going to have jobs. And I'll tell you more about that, why, when we get further down the road. And then I think supply chains have a lot of friction in them, and we'll see how that plays out, but it will certainly take some time. Well, here's where the job, you can see in my little written PowerPoint slide here, you can see where the job losses initially came from coronavirus. Now what's taking place is it's lower demand in the economy that's causing us to see these kind of job losses occurring. And then the question is what happens from here? And most of you all think we're something like 2 years from now, we'll be, or less, we'll be back where we were. And we can all hope for the best in that. Many of you have read about and heard about the unemployment insurance challenge this has created. What we've done here is we've taken the total number of initial claims, so this is all the people who have applied for unemployment insurance, and compared them with the labor force. You see in some states like Georgia, it's 2/3 according to the data, of workers have applied for unemployment insurance, an incredibly high number. At the other end, you've got states that are closer to a quarter. Big differences as to how this has played out. In some states, this is becoming a real challenge in terms of the size of the trust fund balance and whether there's enough money there. And will tax rates or premium rates, as they're called, need to come up on states? I know in Tennessee, we worked really hard so far to keep those rates from coming up very much. Obviously, it's another cost of doing business that in a difficult time is challenging to impose on states. At the same time, we need to help those workers who have been laid off. And so states need to be really careful in this area. Here's a chart to show you, and this is Tennessee data. It's the only place I have this data. And this is who is receiving unemployment benefits today by the industry that they were formerly employed in. Now, when this first started, we've been tracking this week by week, and when this first started, that leisure and hospitality piece of the pie was almost half of it. So basically, half of people got laid off right at the beginning were leisure and hospitality. Every week since then, leisure and hospitality has gone down, and it's broadened out to other sectors. And that's what I was saying. The initial impact was shutdowns. Since then, it's been about falling demand for various kinds of goods and services. To think about, though, where does this leave employment? Here's what I've done. I've said, take employment at the peak of the previous expansion. So this was 2007. And compare it with employment today. This is national data. We can do the same thing for every state. And ask the question, well, where are we today in this? Because, some of these sectors have grown so fast over the last 15 years. Where would things be? Well, notice at the bottom, manufacturing and construction. Neither of those sectors actually had gotten back to their previous expansion levels. They have fallen further and remain well under their previous peak. But we have things like healthcare, like professional and business services, financial activities, where we're still above the previous peaks. And so again, recognize that both the expansion in the economy and the effects of the recession have been very, very uneven. Now let's begin to think forward. That's kind of what was happening from a general economy perspective. If the economy is to rebound very strongly, it must come from consumers. So what I'm illustrating for you right here is just consumption in the U.S. economy. Again, it plummeted. I'm going to show you, I'm going to nuance this for you in a moment to show you it didn't impact everything the same, but you can see consumers really slowed down. But remember what happened. GDP fell like crazy. So there was less production out there in the economy, but Congress and the president were sending massive amounts of money to people. So their income wasn't falling in the same way that the economy was falling. And so we did get this big decline, but in fact, I think it's a pretty short-lived decline in terms of how consumers have behaved in general terms. Now, what are some things that consumers would be thinking about? Well, the factors in their head as they're thinking about whether or not to keep spending. First of all, there is this enhanced unemployment insurance benefit that was good up to July. The president has allowed for the possibility of about 6 more weeks. Consumers were able to spend, and the anecdotal evidence is while consumers saved some of that or paid down some credit card debt, they also bought new washing machines and refrigerators. I've actually spoken with friends and acquaintances, and anecdotal evidence is people were out buying goods as this went on. But some other things going on from the consumer side. I mean, I haven't seen it. Somebody should send a text and let us know what's happened to the S&P today. It's just below its historical high. What we have here is sort of a disconnect between much of Main Street and Market Street. The financial markets have come back like crazy. Alan, I should have been talking to you because that bottom down there that happened in March, April, I needed to be investing right then because you can see the markets just came back like crazy. So this has helped households stay in better financial condition than they otherwise would have been, and so really helpful to households. What also has helped households has been oil prices. prices plummeted. Now we probably have some people from Texas on, and the thing to keep in mind is there's two sides to this oil market. There's the production side, and we did, particularly earlier in the pandemic, have some real problems with oil prices. Oil production has fallen significantly, hurting those parts of the country that are producing oil. But those of us who are consumers, the prices are low. Of course, we're not going out very much, but it is helping us to the extent that we're buying gasoline. Now, here's the picture you really want to get about what's happened to consumers. So this is service demand March through June by category. You can see the far left over there, 9-10% reduction in this window, March through June, of consumption. But look how differently the picture is across industries. If you're in services, and all of us could sit here and say, okay, what services are we talking about? Hotels, restaurants, movie theaters. Right there is the University of Tennessee football stadium, and we're going to see whether or not football takes place. The SEC says they're going to play. We'll see. These socially dense services have really declined. Non-durable goods, on the other hand, no decline at all in this window. Durable goods, that's big things like cars and so forth, a little bit of decline. I'll show you a little bit more on that later. Bottom line, services took a hit. Goods have not. People are out buying sporting goods. They're buying bicycles. They're buying equipment. I just saw today Home Depot came out, 35% increase in Home Depot foot traffic. People are out fixing up their houses. And so it's actually been less of an overall negative than many people think. And again, as I noted at the beginning, I feel almost like I have to look at data every week, because what we see is in June, and by the way, if you're a sales taxing state, and of course all of us, I think on this call are taxing sales, but Florida, Tennessee, Texas, that rely on a sales tax without an income tax, this has been great for most sales taxing states, because we're sales taxing many more goods than we are services. And so in Tennessee, we had 6% growth in sales taxes in the month of July from a year ago. I mean, this is pre-pandemic comparison, and people are buying things that are sales tax. I know Florida's been hit a little harder because of the tourism component of that economy, but as a general rule, I think states are going to find their sales taxes doing much better than many people had anticipated as we go out, buy the sporting goods, go to Home Depot, and all the rest. Here's the picture of what's happening on the durable goods side. Light vehicle sales, you can see they plummeted initially. They're coming back. And if I don't know that I'll have enough time to go into this much at the end, but if you look at what's happening before the pandemic started, notice that vehicle sales were already declining. With the advent of the sharing economy, and we'll see how that all plays out with Uber and Lyft, we were seeing cars coming down. I'm a believer that with autonomous vehicles in the horizon, we're going to see fewer cars sold. A lot of implications on the development side of the economy for this region, many states in this region. We're getting some kickback here right now, though, from the recession. We're seeing it's coming back up, but we will have fewer cars sold this year, even in the second half of the year, than we did a year ago. Housing is the same kind of picture, although much brighter. Interest rates, mortgage rates in the 3% range, a lot of property changing hands. And so single family homes are roughly back to where we would have expected them to be anyway. I mean, the thing about this recession, I'm getting old. I've watched lots of recessions. I've been an economic commentator through them. This is different from anything we've seen. All this goods consumption in a recession, housing back where it was before. This is a unique time period. It's the services that have been hard hit. And what we need, obviously, to get is a point in which consumers feel comfortable going to the movie theater, going out to eat, traveling. As we see that happening, the economy will begin to rebound ever more strongly. Let me talk about a few trends that I think were accelerated by COVID-19. These were things I was already talking about, so there's nothing new about the point. It's just what I'm trying to say is, hey, this is a lot faster taking place than I thought it was going to be. So the first one, many retail and restaurant job losses are permanent. And to just show you a slide to make this point, this is one list. It may not include everything. If you know some others, this is the kind of graveyard slide. But I'd love to hear any thoughts that you have on that. But this is a list of companies that have filed bankruptcy. Now, many of these firms will continue to operate. So I get that. I'm not arguing they're all gone forever. What I am arguing is that many of these firms will be back right-sized at the other side of a recession. A bunch of people who think their job is coming back are going to find their job does not come back. Economists call that structural unemployment. And I do worry about where structural unemployment goes. And we get to the end of this year and a bunch of companies don't open all their stores back up and these people don't have a job. Where do they transition to quickly? And I think this is a huge challenge for every state and for the country. We have never done a great job of helping people move from one sector to another. This is a big issue. So think restaurants, and retailers shutting down or at least shutting down some stores. The other end of this, it will be a much more challenging time. Second thing, and kind of related, retail space falls and fulfillment space grows. Now, again, these are things I was talking about before. We're just accelerating it all. And so, let's think about what's happening today. So Walmart or Target will have a big truck bring in a bunch of inventory, download it in the back of the store. They pay somebody to go out and put all that stuff on the shelf. Then they pay somebody else to go get that stuff, put it in a cart, and put it outside for you and I to pick up. Now, what a crazy world that is. This is not going to go on. These companies are way too astute to let this continue. And what's going to continue to take place is retail space declines, fulfillment space grows. And so, your local grocery store or a discount department store is going to reduce even if it has the same store, it's going to reduce the front end of that, turn it much more into a fulfillment center. You may have heard even within the last week talk about turning some malls into fulfillment space. The world's going to continue. And what we're seeing is a lot of growth, obviously in e-commerce. Now, this is old stuff, and I show it to you only to say it's growing really fast before the pandemic. But let me just read to you. I just got this morning. These are growth rates for e-commerce activity by comparison with a year ago for recent months. April, 24%, May, 25%, June, 32%, July, 27%. Now, admittedly, you and I are hesitant to go out there to the store, or the people around us are, so we're buying more online. I get that. But what's happening is a bunch of people who never went online before are now going online. And in this world, there's a bunch of those people are going to keep doing it. And a bunch of people have said, wow, it's really convenient to order my groceries and have them waiting for me when I get to the grocery store. And so notice, when I used to talk about e-commerce, I always talked about remote sales, like I'm buying something from Seattle. That's not what I'm talking about. I'm talking about things that are bought locally, shifting from bricks and mortar stores to much more fulfillment will be a big part of where we go from here. Next trend that's underway. Firms are learning new ways to use technology. And so this is teleoffice and telemedicine, for example. In my household, we've done some telemedicine. The doctor, when we did it, he said, okay, next time I want to see you in person. But this time he wanted to see us online, and it worked out great for the purpose we were doing. But also technology replacing workers. Now think about it. Robots don't need childcare. They don't get COVID-19. They don't apply for unemployment insurance. And so we're going to continue to see this trend. And in the fulfillment area, for example, I was speaking actually to a supply chain group a few weeks ago, and the question came up: is really any of this technology going into fulfillment centers? And one of the people actually kind of on the call, and this was a group of leaders in the industry, saying no, it's not taking place. And everybody else said, oh yes, it is. It's really coming into fulfillment areas as well. And so what's linked to that, notice, is it says fewer low-skilled jobs in the economy after the pandemic. This is a really big concern that I have, that we're going to end out replacing people with machines, with technology, finding, as we're shifting what we want and the way we want it, we go online, it uses less workers. Some years ago, I did an analysis at that particular time, and it's old, so let me tell you that it's old. But at the time I looked at it, Walmart was hiring 5 workers per $1 million of sales. Amazon was hiring 1. As we shift online, while Amazon has hired a lot of people, it doesn't offset all of the impact of what's going on. And so as you think about economic development in your state, these are the actual unemployment rates by education levels in this pandemic. Notice, first of all, that those with higher degrees of education, the black line at the bottom, already had low unemployment. They've been impacted less by this. People with a high school diploma or less having much higher unemployment rates, and the best protection against unemployment and losing your job is having good education and skills. And I know all of you already know this. I'm just tossing it out there. Unemployment rates are lower with more education, and earnings are much, much higher. Okay, so we have a second a question to ask you, which is, what industry will show the best growth during the next year? And so it'd be great if you do that while I talk about, so you're responding to what industry will show the best growth. And I'm going to talk a little bit about investment. I know you all are in the economic development business. You all are looking at investment a lot. Here's the investment data in the recession. You can see very big downturn in it's interesting to see everybody's responses so far. Everybody's saying e-fulfillment and logistics, right? And initially, and I don't mean to bias your responses on it, but I get it. This is a lot of where the economy is going forward. And then the question is, how do we, as states and local areas, how do we help this be successful in our community? Well, investment looks like it's going to be low over the next year. Next year's investment, I think, will still be lower than 2019. Uncertainty of the kind that exists in a pandemic is really an anathema to business investment. And so I'm not very optimistic about investment, despite the fact, as many of you know, that interest rates are incredibly low. When I was looking at the 10-year earlier today, it was 69 basis points. You can see that while the yield curve is upsloping, it is massively lower than it was a year ago. And in fact, get this, most of the world's debt is at 60 basis points or less. Very low interest rates. Tough time if you're getting near retirement and thinking, how do I fund my retirement? My point, though, in this context is business investment is low despite the low interest rates. And the answer is simple. Businesses, while they think about interest rates, in the end, investment is about cost cutting or meeting demand. And in this world of uncertainty, in this world of shifting consumer demands, business investment looks slow for the foreseeable future. And how's this interest rate gotten so low? The answer is the Fed has been incredibly aggressive in getting us to this point. Well, let me give you kind of my view of the economy. And let me say, economic forecasting in this environment is nearly a fool's errand. But I'll give you sort of my take on where we are. We're going to end out this year with GDP, that overall level of production, about 5% lower than it was last year. And as you all already responded, I agree with you. It'll be 18 months to 2 years before we get back to the levels of economic expansion we were at before. And so it will be a good time incoming for sure. You know, what's going to happen is as we begin to take that stimulus out of the economy at the end of 2020, that will help slow the economy down as people don't get those jobs back, as we were talking about. That will slow down the economy. But still, you know, positive growth rates, just less acceleration than we're seeing right now. Inflation will remain low despite all of this. Many people are worried about inflation being high. I don't see that as a challenge going forward from here. You know, firms just don't have any price control at this point in time. So bottom line, the economy is getting better from where we are. The direction is positive. We just had such a decrease. It's going to take us a while to get back. Alan, do you have some questions, or shall I go forward?
Well, Bill, one question that we have, which I think is a good one, that is not only going on with the COVID-19 pandemic, but also from time to time at other points in our economy, we see it going on as well. And that is, why is there always, or not always, but why is there often a disconnect between the market, the stock market, and what the data is really saying in the economy?
Boy, I wish I had great answers for that. I can just talk around the subject a little bit. If I knew it really well, as I said, I'd have invested a lot more in March than I did. I had some cash sitting there, and I put a little bit in the market. Kept thinking there's going to be another chance, and it never came. It was just amazing how the market came back. So a few thoughts on that. First of all, when interest rates are as low as they are right now, then it's reasonable to think that people are saying, hey, where else can I possibly go with my money? I'm going to try to pull back up that here. If I'm trying to retire and the best I can get is 15 to 60 basis points, I look in the market where I might get better return. That's one point. Second point is that the recovery in the market is actually much narrower than many people realize. There are a lot of companies that are way under their pre-pandemic peak. And what we're seeing is that technology companies and electronics companies coming back really well, while other companies, are not. And so it clearly has a lot of buyer mentality in a lot of people. I mean, Tesla is an example, and Tesla has, I'm not a shilling for Tesla in any sense of the word. I mean, here's a company sitting with 0.5% of the world's market share in vehicles or something like that. It's growing fast, but it's sitting at 0.5% of the world share of vehicles, and the price of the stock going up like crazy. I mean, it's a narrow set of stocks that have been bid up really high. And yeah, I'm not a financial advisor. If somebody has great insight as to where the market's going from here, I'd love to hear it.
Bill, thank you very much. Appreciate it. So if we got just a couple more minutes left, I think one thing that would be interesting for all of the participants on this call is a little more of your thoughts on the automotive industry. Yep. And where that industry is going. It's so important to the states in the Southeast, all of the states in the Southeast. And I think we'd just be real interested in hearing a few more thoughts on that.
So, Alan, here was going to be my kind of concluding remarks, some about demographics, some more about e-commerce, but we've mostly talked about that. Vehicles and where they go from here, I think, is really a key issue. And here's a chart that evidences the pace at which various kinds of technologies have been adopted over time. Look at telephones and electricity and automobiles, and all these are old hat to us, but it took 50 years to get these things broadly adopted in the U.S. economy. Smartphones took less than 10. Tablets, again, similarly, kind of really short time period. We're in a world where these technologies get adopted really fast. And so where I see the world going is electric cars. And I mean, you get outside the U.S. and most of the rest of the world is really pushing for electric cars. That China, the EU, for example, moving much faster than the U.S. What I believe is linked to that. Over the next decade, we're going to see a lot of adoption of autonomous vehicles in a range of things. And autonomous vehicles are going to be electric. They're likely to be owned in fleet companies like Uber or Lyft or Waymo or whatever. And here's an example. Here I have Tennessee and U.S. data that we put together on what shares of the economy are linked to vehicles. And notice, this is employment. In both the U.S. and Tennessee, about 1 out of every 5 jobs are linked to vehicles. Now, notice the vehicle manufacturing at the top. In Tennessee, it's nearly 3%. In the U.S., a little less than 1%. It's important. And remember, you guys more than anybody recognize this, that about 2/3 of those jobs are parts manufacturers. And about 1/3 in a state like Tennessee are vehicle assembly jobs. And the thing to keep in mind with these parts jobs is they're spread all over the state. And so as this transitions, it's going to transition across the state. It doesn't just hit those few places where we're assembling vehicles. And the thing is, and I'll get the detail wrong, excuse me. So don't get my detail here. But the guy running BMW recently said there are 1,800 parts in a internal combustion engine vehicle, and there's 18 in an electric engine. I mean, what's happening is the number of vehicles and the technology, number of parts, and the technology in those parts is transitioning fast. And so the spread of jobs across states is likely to be impacted even without autonomous vehicles. But the point that I also emphasize here is, notice the vehicle support. This is the car dealers and services associated with vehicles. 4 to 5% of employment. And as we move to more fleet vehicles, many of those jobs, and to electric autonomous vehicles, many of those jobs go away. And then finally, those people, from the FedEx driver to the UPS driver to the large 18-wheeler drivers, but ambulance drivers, garbage truck drivers, just go through the list. Huge share of the economy. These transitions, while it's not going to happen overnight, it will happen across 25, 30 years. Think of these industries as being in relative employment decline from now on. I mean, once we get through this current time, we're going to see 25, 30 years of decline in these industries. How do we replace the jobs? How do we transition the people? I'm not saying we can't do it. I am saying this is, I think, the biggest transition we have seen in the modern history of the. I mean, it sort of parallels what we're seeing on e-commerce with similar kind of pace and with a much more dispersed set of jobs. So I think this is an incredible industry for the group of people on this call to think about.
Great. Thank you, Bill. So I think we have about 2 more minutes left. And I think I'd like to ask one more question of you that is also very important to a lot of the southeastern states, and that's foreign direct investment. So many of the projects and many of the companies that we all pursue to come to our states come from international countries. Right now, we are obviously facing a real challenge with borders being closed, which does not allow us to travel to those countries, nor does it allow those companies from those countries to travel to our states. So any thoughts, I'm not going to ask for your prediction on when international borders are going to open up, but any thoughts on how this pandemic is going to affect the global economy from an FDI attraction standpoint?
So in the near term, I think the pandemic has clearly impacted exports and imports. Now, that's different from the investment that you're asking about, but we're going to see 13, 14, 15% decline in imports and exports. So big impact in the near term. Over the longer term, actually, Alan, much of my concern is a political concern, and it doesn't really matter. I'm not making a political statement. Whoever's president, we're going to hear a lot of conversation around, should we be making those drugs in the U.S.? As just an example. But as we look at companies like Huawei, when we look at Alibaba and TikTok and so forth, is if we begin to limit U.S. companies' ability or U.S. people's ability to work with those companies in the U.S., then we should expect similar kinds of limitations on the U.S. And so one of my fears is that we might see retaliation as both sides begin, and I'm thinking China and U.S., but it can be, of course, much broader than that. As across the world, we actually begin to reduce foreign investment and imports and exports. My view is that global trade has been an important source of economic growth in the U.S. and in the world for decades. Now, I sort of get the idea that we might want to make some medicines in the U.S. I just think we have to be really careful about the trends and the patterns we're creating going forward. So I worry about the political dimension of this as much as the economic. But if the political dimension doesn't limit it too much, then get us a couple of years and we'll see the economy will be back where it was. We'll be back with all the technology enabling us to continue to grow at the same kind of very fast pace we were before.
Great. Thank you very much, Bill. So I think this is a part of the show where I say thank you for all of your great insights. Thank you for all of the information that you've shared during this session. And I normally, if we were all in a ballroom in Nashville, I would ask all of our audience to please give Dr. Bill Fox a big round of applause.
Thank you, Alan, very much. I appreciate it. Thanks for having me. Enjoy the rest of the conference.
Thank you. Thanks, everyone.